Welcome everybody to the Physics of Investing. In today's video, we're going to be talking about what to do in a stock market correction. Now, anyone that's watching this video in the stock market right now is probably making a lot of money. And that's because just about everybody's making a lot of money right now that's invested in stocks. I'm going to try and talk about why. I'm going to give my outlook on the market, and then we're going to talk about what all this means for us as investors and what we should do. I'm going to show you a chart, and this is the S&P 500 index over the last 3 years. As you can see, since we hit those lows in March, we have went on a 75% run. We blew right past the previous all-time highs, and we're sitting at brand new all-time highs as of this recording. Now, that's including having a lot of the economy still closed. We haven't really fully recovered from the pandemic, and there's just a lot of variables out there that people aren't really paying attention to. Everybody's kind of just going in stocks, trying to make a lot of money, but nobody's really looking to the downside. And I think we're at a point of max euphoria, or getting to that point, and that leaves us a lot of room for error in the stock market. I'm going to show you some forward price to earnings for S&P 500 small caps, mid caps, and large caps. Now, if you look at these forward price to earnings, which is analyst projected earnings, versus the price of stocks for large caps, you can see we're reaching levels that haven't been reached since the dot-com bubble in 1999. Basically, it's the same thing for mid caps as well as small caps. Now, this could have to do with all the enhanced liquidity. You know, the Fed has been printing a lot of money, giving it out in stimulus checks, and that's been pushing up valuations to levels that we haven't seen in a while. And even though there's a lot of liquidity and stocks have been pushed up, the way I see it is companies are not really being valued for what they're earning anymore. They're kind of being valued off of how much liquidity is going around, is in the market, is in the economy. And I feel like that leaves a lot of room for error, because companies aren't being valued based on their performance anymore. Moving along, we can see that margin is at an all-time high. According to this chart, FINRA has released new data for margin debt, now available through November. The latest debt level is up 9.53% month over month and is at a record high. What this means is people are investing with borrowed money at a record level. What this means for us as investors is stocks will have more violent crashes. I don't know if any of you have ever invested on margin, but I'm sure it's very, very stressful. I just get stressed when I don't have enough cash around and I'm investing in stocks, and it makes me anxious, and I'm more willing to sell and more quick to sell. Now just imagine if you're doing investing with borrowed money. Imagine how quick you'd be willing to sell if things started to turn against you. This is a real problem because valuations are already pushed really high, and on top of that, we have a record level of people investing with borrowed money. That's step 2 to setting up our recipe for disaster. This means we could have more violent crashes and quicker stock market crashes. Moving past this, we'll take a look at the money supply, and this is probably going to shed a little bit of light on why valuations have been pushed up so much. As you can see, the money supply has increased. It's almost 50% or more. Yeah, over 50%. And where's all this money going? You got to think, okay, a lot of the money supply has just been created. The Federal Reserve has been pumping out money to get us through the pandemic. Now, where's this money going? There's a few places you can put your money. You can spend it, right? But we know that the economy still isn't fully reopened, so a lot of the spending that could have happened in the past is not happening right now. And we know if it is spent, I don't know if you guys know how inflation works, but just because the money supply has increased like it has been, that doesn't mean inflation is going to start kicking in. What really kicks in inflation is money velocity, and that's the spending of money. So right now, a lot of things are closed, so not a lot of people can spend their money. But if it is able to be spent and money velocity starts increasing as things open up, inflation is going to kick in. And that's going to be really ugly, especially with the money supply being increased 50%. So places to put your money, right? You can spend it, but like I said, that's not really happening right now. And when it does happen, inflation is going to kick in. You can hold it in cash, but nobody wants to do that because on average, inflation is about 3%. And I'm going to show that in the next chart. So nobody really wants to hold in cash. You can't really spend it. You can have it in a savings account, but everybody knows savings accounts don't really return anything. You can put it in bonds, but bonds right now, their yield is less than the inflation target, which means you're almost guaranteed to lose money if you're invested in bonds. And we're going to look at that chart in the next slide. You can invest in precious metals, and if you've seen gold price has been increasing. You can invest in real estate, same thing, real estate prices have been increasing. Stocks and cryptocurrency, and both stocks and cryptocurrency, those prices have been increasing as well. So basically, there's only a few places that you can really put your money right now, and because the money supply has increased so much, all those assets have been increasing in value, not because of their underlying trust or performance, but just because there's so much money out there. I'm going to show you a graph of the 10-year U.S. Treasury bond yield. If you take a look at this, you're going to see that the yield right now is less than 1%. And like I said, inflation is an average about 3.10%, I think. And the yield on the U.S. 10-year Treasury bond is less than 1%. So you're guaranteed, basically guaranteed to lose money. So like I said, nobody wants bonds. And if we look at this next chart, you'll see right here, the long-term average inflation is 3.10%. And you can see the rates of inflation through the different decades and periods of time. So what does this mean for us as investors, for people in the stock market? This means right now, everybody's making money, okay? There's a lot of people making money that don't exactly know what they're doing, and that's because by default, everybody's making money. There's a lot of money in stocks just to be in stocks. You don't want to be in bonds, you don't want to be in cash, you don't want to be in a savings account. Everybody wants to be in stocks because that's where the money's at. What I see this leaving a lot of room for error. We could experience a significant correction, 10 to 20%, right, with no problem, just because there's so much room for error, because valuations aren't even attached to the performance of the companies anymore. They're just attached to liquidity. So what can we do to kind of hedge this? Well, we know keeping cash is we're going to lose value over time. But at the same time, valuations are pushed up. And the way I see it and the way I've been taught to invest is you should always keep 10 to 30% cash. So if you have 0% cash right now, you should really consider keeping some cash around just in case of a correction. And then you can buy more stocks. So I'd suggest keeping some cash around. You can also invest in some of these other assets. Like we talked about precious metals, real estate. I've recently been looking into Bitcoin, cryptocurrency. And once you start researching it, it begins to make a lot more sense and is not as far-fetched and sketchy as some people make it. Of course, it has its problems, and maybe I'll go over this in the next video, but I've decided that I'm going to open up a position in Bitcoin, especially because it's just been corrected recently, I think about 30%. So I'm going to start a position in that, and if you guys want me to make a video, I'll talk about that. So what I think I'm going to do is I'm going to keep 10 to 30% cash. I'm going to start a position in Bitcoin. I'll probably have about 10% of my money in there to hedge against inflation. And yeah, for us, I'd say you need to raise some cash, right? You can't ever go broke taking a profit. Valuations have been pushed up. Everybody's making money. This isn't going to last forever. Stocks don't go up in a straight line. I wouldn't say sell all your stocks because, like we said, if inflation does kick in, that could push up asset prices even more. So 10 to 30% cash. Don't sell out of all your stocks, Just be ready. You want to be prepared for anything. In order to be successful in the market for long periods of time, you need longevity, okay? You need to be prepared for, that basically means you need to be prepared for any market condition, anytime. You need to be ready for all adversity because really making money and being successful is doing it over the long term, not just short periods of time. So I'd suggest if you haven't built any cash, I'd really recommend start building some. And then possibly branch out into other types of assets to hedge against the coming inflation that I see is going to start ramping up once money velocity increases. So that's about it for everything today, guys. Just keep some cash around be ready for some adversity, because I think there's definitely some on the way. I've raised about 20% cash, and I'm just about ready for everything. If you want to be successful in the market too, you also need to be ready for everything. So that's everything, guys. I hope all of you guys have a great day.